Welcome to the first chapter on financial management in the IPTG Level 7 Diploma in Strategic Management course. Today, we will be discussing the complex relationships goals and governance practices involved in financial management. Our focus is on increasing shareholder value through effective governance strategies. Throughout this chapter, we will examine the finance function in a business and its connections to other departments within an organization. We will also explore theories such as agency theory and stakeholder maximization, which aid in aligning objectives with shareholder value. Furthermore, we will cover crucial topics including managing agency costs, aligning directors' goals, and adhering to the UK Corporate Governance Code. Our main objective is to recognize the significance of financial management in achieving long-term success and maximizing shareholder wealth. Let's begin our exploration of the world of financial management. Welcome to this presentation on financial management in business. We will explore the crucial role of the finance function in organizations and its interrelationships with other key functions. Our focus is maximizing shareholder value through effective governance strategies. Financial management aligns organizational objectives with shareholder value creation, incorporating theories like agency theory and stakeholder maximization. It also involves managing agency costs and aligning directors' goals with company objectives. The Corporate Governance Code provides guidelines for maintaining balance in governance structure. The ultimate goal is to maximize long-term shareholder wealth through strategic financial decisions that consider the interests of all stakeholders. Let's discuss the complexities and importance of interrelationships, objectives, and governance practices in financial management. Thank you for joining me. In our previous discussion, we covered the duties of financial managers and the significance of prioritizing shareholder value. To further our understanding, we will delve into the intricacies and connections involved in financial management. The upcoming slide will examine different governance techniques and tactics that aid in the fulfillment of a company's goals and ultimately benefit its shareholders. As we proceed, remember the vital responsibility of financial managers in connecting capital markets and a company's functioning. Welcome to slide number 4 of our presentation. Today we will be discussing complex interrelationships, objectives, and governance practices in financial management. As teachers in higher education, understanding how to maximize shareholder value through effective governance strategies is crucial. The agency problem, which results from the separation of ownership and management in a company, must be addressed. This can cause conflicts of interest between shareholders and directors. Directors have a duty to act in the best interests of shareholders and protect their investments. Managing agency costs is crucial in order to preserve shareholder value. These costs, whether direct or indirect, can decrease the value of shares through unnecessary expenses or suboptimal decision-making by directors. This emphasizes the need to align the goals of directors with those of shareholders in order to maximize shareholder value. The UK Corporate Governance Code provides guidelines for transparent, accountable, and balanced power structures within companies. Key principles such as wealth maximization, profit maximization, and ensuring business survival are essential for effective corporate governance. In the realm of strategic financial management, our main focus is on maximizing shareholder value and promoting sound governance practices. Understanding the nuances of financial management is crucial for driving business success and ensuring long-term sustainability. To conclude, we have discussed the agency problem and the importance of managing agency costs for the preservation of shareholder value. We have also emphasized the need for directors and shareholders to have aligned goals for the benefit of all stakeholders. The UK Corporate Governance Code provides a framework for effective corporate governance which is vital for the success of any business. Thank you for joining us, and let's continue to our next slide. Students, in today's discussion, we will delve into the significance of interrelationships, objectives, and governance practices in financial management. Specifically, we will focus on how these practices contribute to increasing shareholder value. As you may be aware, the finance function plays a crucial role in strategic financial management within a business. This involves making decisions regarding investments, financing, dividends, and risk management. The financial manager serves as a bridge between capital markets and the company's operations and is responsible for wise allocation and utilization of funds, accurate valuation of long-term risky assets is a key aspect of financial management, ensuring decisions that benefit shareholders and the company in the long term. Furthermore, financial markets provide valuable financing sources for corporations, liquidity for investors, and information on interest rates, raw material prices, and market values of companies and securities. However, the separation of ownership and management can result in principal-agent issues and agency costs, adversely impacting the value of shares and overall company performance. For this reason, the primary goal of any business should be to maximize shareholder wealth while also considering the needs of other stakeholders and adhering to ethical standards. As agents, directors have a fiduciary duty to act as protectors of wealth, safeguarding shareholder value and ensuring sustainable growth. This is where effective governance practices come into play. The UK Corporate Governance Code sets standards for clear delineation of powers and responsibilities, appropriate checks and balances, and a well-balanced board of directors for effective governance within companies. To sum up, the finance function plays a critical role in maximizing shareholder value through effective governance strategies. As we proceed to the next slide, let's remember the importance of shareholder wealth maximization and the role of directors in promoting good governance practices. As we continue our discussion on financial management, our focus now shifts to the primary objectives of organizations and the significance of maximizing shareholder value. This approach goes beyond just maximizing profits and takes into account the needs of all stakeholders while maintaining ethical standards. Maximizing shareholder wealth is crucial for businesses to succeed in competitive economies, along with the basic goal of survival. Long-term success through wealth maximization ensures sustained growth and prosperity. This approach also considers risk and long-term returns, providing a more objective measure of performance. It is essential for organizations to prioritize shareholder value, as it aligns with their needs and leads to long-term success. As we further explore the complexities and importance of interrelationships, objectives, and governance practices in financial management, let's remember the importance of maximizing shareholder wealth. Continuing our discussion on financial management, we will now delve into the crucial role of strategic management in maximizing shareholder value and aligning shareholder interests with the organization's goals. This approach is vital for businesses to thrive and achieve success in the long term. Our ultimate goal is to drive the organization towards its objectives and increase shareholder value. As shown in the slide, strategic financial management is a critical aspect of an organization's success. By aligning shareholder interests with strategic goals, we can ensure sustainable growth and long-term success. This not only benefits shareholders but also the overall health of the organization. In today's competitive business landscape, prioritizing shareholder value and effective governance practices is essential. This creates a solid foundation for the organization to achieve its objectives and sustain long-term success. Thank you for your attention, and let's continue to explore the complexities and importance of interrelationships, objectives, and governance practices in financial management. Welcome back to our presentation on financial management in the business world. Our next topic is the fundamental concept of strategic financial management, agency theory. This theory emphasizes maximizing shareholder value and effective governance within a company. One important aspect of agency theory is stakeholder maximization, which means taking into account the needs of all stakeholders, not just shareholders, when making decisions. In the relationship between principal and agent, shareholders hire directors to run the company. However, conflicts of interest can arise due to the separation of ownership and management, which leads to the agency problem. This problem results in agency costs, which can be direct, such as unnecessary luxuries or monitoring expenses, or indirect, such as suboptimal investment choices. On the other hand, The stewardship theory suggests that directors have a legal responsibility to act as guardians of wealth and protect shareholder value. Ultimately, the main goal of a business is to maximize shareholder wealth. However, it is crucial to find a balance between this objective and the needs of other stakeholders, as well as maintain high ethical standards for long-term success. By understanding and navigating the complexities of agency theory and stakeholder maximization, businesses can effectively balance the interests of stakeholders while focusing on maximizing shareholder value. Thank you for your attention, and let's continue to explore this topic further in our presentation. Slide 9. Managing agency costs and directors. As we delve further into financial management, we must acknowledge the presence of agency costs. These costs encompass both direct and indirect expenses incurred by an organization, including unnecessary luxuries and monitoring expenses, as well as potential conflicts that may arise when directors prioritize their own goals over those of shareholders. In response to this issue, the stewardship theory emphasizes the fiduciary duty of directors and managers to act as guardians of wealth, safeguarding shareholder value. This principle serves as a foundation for effective governance. The UK's Corporate Governance Code plays a vital role in establishing clear powers and responsibilities for directors, implementing checks and balances, and ensuring a well-balanced board for sound decision-making. Fundamental concepts in governance, such as wealth maximization, profit maximization, and the primary objective of ensuring the survival of businesses, all contribute to maximizing shareholder value. Ultimately, the goal in strategic financial management is to optimize shareholder value while efficiently managing agency costs and aligning directors' goals with shareholder interests. By placing a strong emphasis on risk management and long-term returns, wealth maximization is considered the superior approach. We appreciate your attention, and now let's move on to our next topic. Kindly share the slide number for the next slide. In the previous slide, we discussed the importance of clearly defining powers and responsibilities among directors to effectively govern Company X now. Let's shift our attention to the significance of a well-balanced board composition and efficient time management in maintaining good governance practices. It is essential for every publicly listed company to have a diverse group of skilled, experienced, and independent directors, with non-executive directors playing a critical role in questioning and contributing to strategic proposals. Additionally, it is the responsibility of directors to effectively manage their time and conduct thorough evaluations of the board's performance on an annual basis. Moving on to the next slide, we will address a common obstacle faced by companies' large datasets that are challenging to present visually, despite containing vital information. The size of this dataset presents difficulties in visual representation. Let's explore ways to overcome this challenge. Let's now focus on the critical aspects of risk management, shareholder communication, and balancing powers and responsibilities in governance. It is essential for the board to clearly define the company's risk appetite, implement a strong risk management system, and ensure fair compensation levels to achieve long-term success. Effective communication with shareholders is also a crucial duty of the board, using general meetings as an opportunity for engagement. Moving on, we will delve into the intricacies and significance of interrelationships, objectives, and governance practices in financial management. The next slide serves as a reminder that there is no information available to be summarized. Let's continue our discussion on maximizing shareholder value. As we discuss the complexities of financial management, it's crucial to understand the difference between shareholder wealth maximization and profit maximization in the business world. While the latter focuses on increasing profits, the former considers stakeholder needs, ethical standards, and long-term success. The role of a financial manager is critical in this process, as they make informed decisions regarding financing and investments that benefit the company's shareholders or owners. We must also consider the impact of agency costs on shareholder wealth maximization. These costs can hinder the goal of maximizing shareholder wealth, whether direct or indirect. As we move on to our next slide, let's remember these key concepts and the importance of being proactive and adaptable in financial management for long-term success.